Hey traders, Steven here. It's Thursday, August 16th, headed into the close. We got a lot to go over today. The Nasdaq is kind of diverging from everything else, so we're going to keep an eye on that. The S&P 500, even though up today, it definitely looks like it's slowing momentum. We're going to look at some relative charts to see, how the more aggressive sectors, the risk-on sectors are holding in there as we're getting close to the all-time high. And we're going to look at a lot of individual industry ETF charts to see what's strong and what's starting to perk up and what's starting to roll over. So, just looking at this chart right here, I'm going to kind of start with the Nasdaq. I'm just here on stock charts. Started strong, kind of peaked midday and is starting to come back a little bit. Now the Dow is strong, but I think that has to do with Walmart. And forgive me, when the Dow is up a multiplier of 3 times the Nasdaq, I'd prefer it to be the other way around. The Nasdaq, up 1.5% and the Dow only up 0.5. But you can't go wrong with an up day. You can't get picky. But let's kind of dive deep in a little bit on this. So let's start with the S&P 500 because to me this is really the most interesting chart. So I've been showing you this chart for several weeks now, and how when the S&P 500 is still not at an all-time high, continues to hit this upward trend line, it really just kind of rolls over a little bit. What's interesting though is, actually I'm going to show you that on the Nasdaq. So the last couple times it really just, it did not get, you can see once it hit the top, it went down to the bottom and then created this zigzag. Well, now you can see on this bar, as it was really getting strong up here, it came down, found support at the 50-day moving average, and then you had a gap up on this day right here that closed in the lower end of the range in low volume, and then you had a gap down 2 days later, potential support, and then you had a weak day yesterday, but there was support at the end of the day, so that's definitely a positive, and then it's bouncing today. So right now, we're still in a bull market. It's still incredibly strong. There's way more check marks for the bull market than there is any kind of bear market, but I'm seeing evidence to show that we might get more of just a little 2 to 3% pullback. All I'm saying is, if you're looking to put some more money to work, maybe just let it come to you a little bit more. On another positive note, you can see that the S&P 500 came down and gave this 2800 level a kiss twice and then found support. So definitely horizontal support at 2800. It seems to be finding support around the 50-day moving average zone. I would be really cautious. Every time that I think the market, is just like, it seems extended, the rally's long in the tooth, you start to get chopped out of growth stocks towards the end of a rally, which is typically what happens and kind of what I've been seeing. And then I'm like, okay, it should break down here. Well, a lot of times, right when it just seems obvious where it should break down, it'll pull back and then give it one last hoorah. So I would not be surprised if that happens, if the market just tries to come up, take out this high, and then just kind of give it a little bit of a deeper pullback. Again, until the 2800 level breaks, until this trend line breaks, you have to assume that this line is going to hold, and look for setups more than expect breakdowns. Let's go to the Nasdaq. This is interesting, and you can really, let me kind of go out a little bit longer on this chart. So you don't need to have a MACD to tell that the momentum is slowing on this. Let me kind of get rid of this, and I want to draw some things on this chart here for a second. So let's just, these act like a stock a lot. So when one thing they teach at IBD is they talk about, counting bases, right? Counting consolidations and bases. And a lot of times, that first breakout out of that first base, which is this right here, is the strongest, which it was. And then the second one doesn't have as much momentum. And then by the third base, which would be this, it couldn't even break out and is tired. So does this try to come down? And you can see it found support at the 50-day moving average every single time. Does this try to come back and take out the highs? I don't know at this point in time, but here's what I do know. It broke out right here and made a run. It broke out right here and made a smaller run. And then it tried to break out right here and did not. And it failed. So I talk about all the time, you know, I go through hundreds of charts every day, every weekend. And the most important thing when you're trying to really study charts and study this chart, stocks is to pay attention to the personality. And when a personality changes for the better or for the worse, your eyes need to stay in focus. And what I do know is this just looks like every single stock that when you start to get to that third consolidation, now these are more the third pullbacks, we'll call it third pullback, because I wouldn't really call this a consolidation. Momentum is slowing and it gets tired, and by that time, a lot of times the third time can fail, and then you need a deeper pullback to kind of reset the deck. That is what it is looking like right here, because you see even right here, it broke out, it went up a little bit before it pulled back. It did not do that this time. Now, the bullish argument is, hey, that looks like a little mini cup with handle, and if it breaks out, you know, all is well. I get that argument. All I'm saying is the Nasdaq, you know, is looking suspect, and it probably could just completely break out of this. And if it does up here, I would definitely be cautious just based on this zigging and zagging. I think you'll get choppiness at best, maybe just a little deeper of a pullback. So I'm not calling for anything big. All I'm trying to point out is on the Nasdaq, the personality has changed in my opinion. And that's because it did not break out here. The momentum has slowed and it's tired, and then it got slammed again. When I say slammed, this is like a 2%, 3% pullback. So that's hardly anything to get too scared about. But then we go and look at international stocks, and they're just so weak right now. And it blows my mind that the U.S. stocks can just be so strong, and emerging markets and international stocks can be so incredibly weak. The U.S. stocks are at an all-time high. International stocks are in a bear market. Most of the time, they're going to move together. So to me, I mean, that's one big negative divergence. Now, does the dollar ease a little bit and emerging markets and international stocks start to rally, and maybe they come together and then go off in the same area? I don't know, but there's a big difference right now when you look at U.S. indexes versus international. So just something to consider. So you have, and a lot of times, sometimes towards the end of a major rally, you will have the S&P 500 all of a sudden start to lead, and some of the maybe not more aggressive risk-on type sectors start to underperform. And I think this chart says it all right here. You can see this is a relative ratio, small caps versus S&P 500. They continue to underperform. I showed this chart last week. I'm going to show it again because it continues to move in that direction as the S&P and the Nasdaq are stone's throw away from an all-time high. The more risk-on sectors are lagging. Nasdaq is lagging, the S&P 500, the IBD 50 index, the growth stocks with solid fundamentals and technicals, they have been lagging all at around the same time. So could this all turn around? Sure. You know, and again, don't go out there and sell everything you have. I would stick with the things that you own until, you know, maybe they start to break. If you're much more shorter term, maybe consider taking some profits if the market breaks out to an all-time high. But if you have something you like, I'm not telling you to go out there and sell it, because I have several things that I like. I'm not going to sell it unless they break down, regardless of what the market does or not. If they break down, I'm out. If the market breaks down, you know, I'm going to stick with them because, you know, I'm looking for bigger moves right here. So the breadth in the S&P 500 to me is still bullish. You can't really say it's bearish, although you can see really in the last, I'd say, week and a half that the percentage of stocks above the 200-day moving average are starting to turn a little bit. Now, if I could draw a trend line on this right here, I wouldn't really be concerned until the trend line breaks. But I would say that that trend line, it's probably on that trend line right now. And typically once this gets under 60 in the 50 area, that's more market corrective action. If this starts to roll over and the S&P is still way up here and the breadth just continues to roll over as it's at an all-time high, I would be concerned right now. It's still in bullish territory, starting to turn a little bit. Again, I don't make trading decisions off breadth. I make trading decisions off price and volume. Breadth is second. When I see the breadth starting to diverge a little bit, I will treat any break in action of the price much more seriously. But that to me is still okay. Now the advanced decline line in the Nasdaq, you can see the Nasdaq broke to an all-time high up here. The advanced decline line broke to an all-time high way back here. So the breadth peaked, I'd say about 3 weeks before the price action did. So you got the price action that's still, it kind of looks like a cup with handle, maybe a little flag if you want to make the bullish case for it, which you have to because we're in an uptrend. There's no arguing that. This is an uptrend, clear as day. It's not over to the fat lady sings, but at the same time, you probably want to draw a trend line on the breadth as well. So now you have a trend line right here. Trend line, if that starts to go back up, that's good, right? But if it continues to go down, could be cause for concern, or at least just something worth noting. Okay? A chart I want to show you that I actually hadn't looked at all year. It's an old chart of mine, but it's kind of interesting. Bear with me. So this is the relative ratio of the S&P 500 versus the TLT, the 20-year bond treasury ETF. This is bond prices, not bond yields. So, when this line is headed up, it means the market is outperforming bonds. When it's headed down, it means bonds are outperforming the S&P 500. And looking at these corrections, it's no surprise in the Great Recession. Here is what I wanted to show you. I got an RSI 14 up here, and I don't pay too much attention to overboughts, oversolds, especially overboughts in bull markets because you're going to be overbought. But one thing I noticed when this relative ratio gets overbought, above 70 on an RSI 14, a lot of times then it'll start to go the other way, meaning bonds will start to outperform stocks. If you look at the S&P 500 down here, it does not mean that the S&P 500 is going down. It just means that the bonds are beating the S&P 500. So we look at right here, you can see it happened right here, and then you had the major bear market, which I almost wish that didn't happen there as far as this chart goes, because I don't want to, try to scare you or anything like that. But then you have another one. It happened in 2011, and then really for about 2 years, you can see that bonds outperformed the S&P 500. Then you kind of had a double right here. On the second one, you can see then the market went into a major, still in a bull market, but just bonds were leading the way. And then you had a double right here, and you can see really for the most part, bonds outperformed probably for about 6 months. And then it happened earlier this year, which I wasn't even paying attention. And for the most part, bonds have been performing in line with the S&P 500 or the TLT because you can kind of see it right here. But is it going to, trade sideways with it and eventually go down, meaning that bonds would outperform the S&P 500? I don't know. But looking at the evidence, most of the time, this is showing that there are more signals that when you get this overbought condition in the relative ratio, that you'll go through a period where bonds will start to outperform stocks. And we did for a little bit, so maybe it's already happened, but for the most part, it's still in line. So I'm just really keeping my eye on that. One more argument for this chart, or one more point. If this holds true, this could also, last week I showed some evidence that maybe yields weren't ready to just take off into a roaring bull market. This could be another piece of evidence. Now, this happened earlier this year, so this is a long-term chart. But my point is, obviously, if the TLT rises, the bond yields are going to fall. So just something worth noting. Let's get into the CRB, the Commodity Index, because, boy, it's looking ugly. You finally have the death cross. You have the 10-week going under the 40-week, death cross, bear market. I don't know if you're still in. I'd just be cautious, because you can have, look at the dollar. Look at how steep it went and how far down the CRB went, right? This, from mid-2014 to early 2016, the CRB, all commodities, literally got cut in half when the market was doing good. So my point is, the CRB can move in the opposite direction of the market. Not only can it underperform, it can underperform in a big way. So I'm just not a fan of just buying and holding commodities long term. I think that if you are more active in your trading or in your investing, that when you get this death cross, or when you get the relative ratio where it's just clear as day that the stocks are outperforming commodities and are outperforming bonds, and you can look at long-term charts, why not own the strongest one? Like, why not? Like, why would you want to have such a drag on your portfolio? And I'll give you a perfect example. One of my wife's 401k, it had some international stocks, mutual funds, and I was really, really dragging down the other, it was half in U.S. stocks, half in international stocks. It was really dragging down the performance of the U.S. side. And I finally, not that long ago, I was just like, you know what? Because this really just, the international stocks really never recovered after February, and this was several months ago. Finally, I was like, well, why not just own one of the strongest ones? Now, I'm not telling you to undiversify. I'm just telling you that when you have something that's in a bear market and you know how to identify these signals, as you should, at least by watching these webinars, then you can make some long-term moves. And then when it gets back into favorable, you can, do your thing. So I'm not going to tell you what to do. I'm just saying be aware that we're now in a bear market, and that can seriously put a drag on some of your long-term investments. Just a quick look at emerging markets, and it is, and I've been looking at this once a week. It's a slaughterhouse. It really is. It was in a raging bull market. Emerging markets doubled in 2 years, smoked the S&P 500, and then never recovered in this year's bounce. Just never came back. It bounced and then just absolutely rolled over. Yes, it has to do with the dollar, but it's just ugly. It is incredibly ugly. So commodities and emerging markets are typically correlated, inversely correlated with the dollar. So there you have it. It's an ugly chart. Speaking of inverse correlation with the dollar, you have GDX, and this is really, really interesting. So the GDX has just been in a massive trading range. Like, I could draw a box around this sucker. And if really you would have asked me, I would have said, it's trading in this box. It's probably going to stay in this box until it breaks out. Because normally this looks like a first stage accumulation. Even though sometimes you look at stocks, these first stage accumulations, they can take a long time. They can base, they can take a year, 2 years, 3 years, and then they break out, and then you're in the accumulation phase. So I bought, and I'm just going to make the case. I hope you listen to me. I'm going to make the case for why you have to use stops. Yes, a lot of times you get stopped out, it'll reverse, bring you back up. But I bought gold right here. I was like, man, this looks right. It was breaking out. Everything looked right. Gold miners were breaking out relative to the metal. Just all signs were there, right? I wouldn't do anything different. And then the breakout just didn't work. So I sold somewhere right in here, maybe for a 2 or 3% loss. It wasn't that big of a deal, right? I said, you know what? It just didn't work out. So then I sold right here. I could have said, you know what? Let's see if this long-term support holds. But I had a plan and I stuck with it. Well, it didn't. Look at this drop in GDX gold miners. Came all the way down to right in here. My point is, you use stops, and a lot of times it won't be this dramatic, but you talk about a bad month. If I were still sitting in that, I'd be an angry man every day I wake up, because now you're hoping and praying it comes back when the dollar is in this raging, bull market, and you could be waiting years. Because, I mean, we can look right here. This gold miners ETF, the high was back in mid-2016, and it is still 40% under this high, like not even close. So that's why I don't really buy and hold commodities. I just try to rotate on a relative basis. But it's really interesting how gold, the price of this GLD right here, this broke down. Same time this failed, it was time to get out. And then this happened. So you definitely don't want to own a leveraged ETF when support starts to break. There will be a lot of people out there that tell you, hey, you don't want to put stops right in the obvious spots. That's exactly where I'm going to put it. Even if a market maker runs it out, just because I don't want to find out what could happen next. I try to set them to where they're small, where a loss can be small, and I can, I just go make a sandwich and forget about it. So commodities are just looking not so hot right now. Actually, I want to wait before I go into that. I want to show you a couple of sectors. So this 50, and this is a gauge that I look at, and I really just want it to outperform the S&P 500 on a relative chart. Looks like the Nasdaq couldn't break an all-time high. It's really, really lagging right now. And these are typically, when a bull market is over, and I'm not saying it is, or when a correction or pullback, a lot of times growth stocks, they'll be the first to go. They'll get knocked off the top because they've been up the most. This is lagging quite a bit. So could this, take another stab? Sure. But that's lagging. Another thing I wanted to show you, just because I have an affinity for Chinese internet stocks, this Crb right here. So the Chinese internet stocks, the Alibabas of the world, the Weibos, ZTO, things like that. Man, this is in such a free fall. I haven't seen something like this in a while. I just call it the waterfall, where it just goes straight down. That is very, very extreme, very risk off. Could there be some long-term opportunity? Maybe, but you're not going to get me to buy that. I just don't have the guts or the kahunas to step in something like that. But my point is, this is a very risk-on ETF that can outperform the market significantly, and it's slaughtered. And it has to do with, trade wars, dollar, stuff like that. But these are just kind of some side ETFs that I look at. Now, one thing I do want to show you. So yesterday, the marijuana stocks popped. And let me go out a little bit further. And they popped because Constellation Brands invested $4 billion in Canopy, I think it was. And the liquor company invested in the cannabis producing company. And this is a long-term chart. So this ETF went absolutely parabolic. It has just gotten slaughtered. I mean, if you can find a pattern on here, let me know, because I cannot. Yesterday, a lot of marijuana stocks popped, and I keep coming back to, eventually, the marijuana stocks, fundamentally speaking, are so expensive. Just, multiples and multiples that they shouldn't be selling at. But that really doesn't matter when you're looking technically. My point is, yesterday's investment in Canopy could be a catalyst to maybe start paying attention to cannabis stocks again. So this is a very, very ugly chart, and all of them look this way. There's not that many that don't. But now all of a sudden, I'm kind of paying attention. You talk about, you know, personality changes, and that's always what I look for. Even though this could be a one-day pop, I'm going to keep an eye on it, because what if it comes down and then it curves around and then it breaks out of this? Like, I'm not buying this. If this breaks out straight from here, I'm not buying it, because it's just a straight-up reaction. I'm going to look for kind of that first consolidation or retracement, but it could be there just because it's sold off so bad. Don't get me wrong, when this breakout happened, I was buying right in here, made money on several marijuana ETF stocks. I thought that this was going to create a deep, deep cut, and then they were going to just take off again, and it just didn't happen. But I had my stops in place, and I just got out, made money in all of them. But it's funny, I made money in all of them, but I was disappointed because I had much higher expectations. But, you know, back to the using stops, I put the stops in the obvious places, and I just got no problem with doing that. But I'm glad I did, because now look, I mean, who cares if you get stopped out? I mean, this is what can happen. Again, I probably had stops, I don't remember, somewhere in here. I remember I was in Omaha watching the Razorbacks lose the national championship, but and then they just started to sell off and get slaughtered, and then here we are. So just kind of another interesting specialty ETF, but looking for a catalyst, I would start to pay attention, because now people could start to think that some of these other you know, Constellation Brands is investing in marijuana companies. They're really the first as far as, you know, U.S. liquor companies in the vice space that could, you know, people will be thinking that others are going to get bidded up because they sure did pay a premium. Let's look at the sector summary, and then we'll go kind of keeping an eye on things. Let's look at the sector summary, and then we'll go over to the individual sector industry ETFs. So today, consumer staples are up the most. That has to do with Walmart, I'm sure. Walmart gapped up 10%. Haven't seen that stock up 10% in a while. So you have utilities are up 1%. So you have a lot of stuff that's up 1%. Technology and cyclicals are towards the bottom. Those are your two most aggressive sectors. They're down. Not a big deal on a one day, but you look at the last 1 week, consumer staples, utilities, they're the two leaders, and they are defensive sectors. So again, sometimes you just want to pay attention, even though the price action is telling you the market's okay. Pay attention to some of these other things that might be going on, because they could sometimes paint a different picture. But always, in my opinion, use the price action first. So let me... Okay, I have a list of about 25 industry ETFs. You have the industry and then the sectors. So let's just go through some. I'm going to go through most of these. I might pick and choose a little bit, but just see if we can see any personality changes. Telecom, I would say, definitely is changing personalities. Kind of like, and this is definitely a... probably more defensive utility type sector. But look at this. I mean, you have Telecom that is breaking out of a downtrend that goes all the way back to December 2016. So 18 months, that's a serious downtrend. You're about to have a golden cross. It's probably going to happen. You have hit rejection at the 200-day moving average, built to base, broke out. It looks to me like the trend has completely reversed and is pretty bullish right here for Telecom right now. So, you know, when you get to sometimes the summer months or just the window dressing of some of these institutions, they're going to find value. They're going to start to pour money into more undervalued sectors. And, I mean, Telecom, it's clear as day to me that it's pretty undervalued. Well, I'll say undervalued. It's not doing so hot until now. So you have the KRE, the paying attention. It's kind of breaking out right now, but it's really not that spectacular. But one could make the argument that it's breaking out of a little horizontal base and breaking out of a downtrend. So this would just be kind of something I'm watching. I'm more looking for, you can see that the relative strength ratio is starting to break out, but this is still, to me, lagging most of the other industries. The tech, we can just look at a weekly chart on this one, is up right now, and is pretty close to, I'd say, 3% to an all-time high. So right in line with the Nasdaq. Nothing really special. It looks like it's creating a cup with handle. Has always found support at the 40-week moving average for a very long time now. So you have to assume support's going to hold until it doesn't. Looking ugly. XME mining ETF. There's nothing good about that. Like, it broke the 200-day. It broke, you know, the downtrend line right here. This commodities. So it's not for me. Not for me. After you see commodities, I mean, this was in the middle of a bull market. This sucker went straight down. So I'm not saying that's going to happen again, but all I'm saying is they can go the other way for sure. You have aerospace. This is basing one nice base, which you know, makes sense, and this could get some love because I think Donald Trump just gave the Pentagon more money. But look at these long-term bases. So now this is a very, very long-term chart, but man, they can base for a while. You know, the longer the base, the higher in space, and then they break out, base on top of base, and then make a nice run. So I would just pay attention. This is looking like it's ready to break out. Financials ETF, that kind of looks like the bank ETF. The hack ETF starting to get a little sloppy. Cybercrime ETF, but for the most part, I mean, it's been a big winner. So it's 4% away from an all-time high. So just looks a lot like some of the other tech stocks. Man, I'm glad I sold an oil stock last week because oil was right about here. I'm like, you know what? This looks like it's going to crack. And then I swear the very next day it did. So maybe it was luck. But it was just looking weak. So you have the XOP right here. It's not really a good trend line, but either way, it's curling down, and it's looking like it could be in free fall mode. So the commodities have been going down, the miners have been going down, and oil was the last one to really hold up. And somebody that I follow made a good point: is oil eventually going to come down with the rest of them? And my guess is now that yes, I would confirm that it did. Copper miners in a bear market. Not for me. I mean, you can take one look at that chart and say it's broken. I'll just get out of the way. Utilities is looking kind of bullish. I'm not going to lie, because you have a relative strength chart that's been going up. You have a golden cross right here out of a major sell-off. You have a break above horizontal support. You have a base on top of a base, and then you have a breakout right there. What's not to love? So I don't know if that's a good thing that utilities are rising. Could be that yields are pulling back, or it could be that, you know, the time of the year. But say utilities are in an uptrend. Home construction, death cross, downtrend, relative strength, not good. I don't really see anything that makes me want to go out and buy home builders right now. MLP. Excuse me. So you got a golden cross right here, positive. 7.5% yield. Completed a weekly reversal right down here at the bottom. Funny how, that's a nice little plug there, but nice little pattern right there. And if we go look at the daily chart, it's getting a little sloppy, building a high handle. But, you know, for the most part, it did. Here, I kind of want to draw a base right here. It kind of did go up. It broke out of the base. You got the golden cross right here. So I'm interested to see if it'll find support right here. Biotechs are pulling back. They're 8% away. The XBI, which is the equal weight, is 8% away from the all-time high, so it's kind of weakening a little bit. We'll just really have to keep our eye on that. Healthcare providers, probably the strongest industry ETF. This is a bull. It is way, way above an all-time high. This is, everything looks right. Doesn't seem to be fazed by any short-term weakness in the market whatsoever. So healthcare providers, IHF, might worth looking at that. Steel, I bet it looks like copper. Yes, it does. Death Cross, not interested. Retail is looking pretty bullish. You know, the interesting thing is, look at that base. This is one heck of a base. Retail, that's a bad place to draw. But retail has not, this ETF goes all the way back to the beginning of 2015, 3.5 years. That's one heck of a base. Let's go to, I'm kind of interested in the monthly chart. So, man, and that's what happens. So you have these, you could even argue that goes back to 2011. Actually, I would probably argue that. Just pinballing around, and maybe it has to do with the rise of a lot of these, you know, online tech, you know, the Amazons, which has just put so much pressure on these stocks. If this breaks out, I think you need to pay attention. Retail stocks have already been up quite a bit, but it's worth looking at. Medical devices, a lot. So we're seeing some healthcare. We'll see healthcare provider, medical devices. This ETF is bullish. Let's look at the Reits. Looks like utilities to me, except for maybe a little stronger, but you have a golden cross right here. It's basing on top of that crossover. REITs are more defensive, along with utilities. They're also going to be inversely correlated with the yield, so looks kind of interesting. And then gold miners, which we already saw is just in free fall mode. So I'm not touching that. So I hope this was helpful. Let me know if you have any questions.